Please zip your pants back up. We're going to be talking about a dividend ETF that you have never heard of, and that's better than SCHD. And no, that wasn't a lie, like that one time you farted in the car with your wife as the passenger princess, and you blamed it on your dog that was sleeping in the back seat. Color me shocked if that act alone landed you on Santa's naughty list. The name of this dividend ETF is DIVB, which if you don't mind, I'm going to refer to it as the buyback ETF. And if you do mind, well, you can go ahead and shove a frozen grape right up your small booty hole. Anyways, it's an ETF that collects companies that pay dividends and share buybacks. And as soon as I said that word share buybacks, I probably lost you already. So let's go over that right now. So what is the primary objective of a company that's publicly traded? Well, sir, the mission of a publicly traded company is to be profitable through their products or services, and by doing so, giving a healthy and sweet return on investment for the shareholders. Now, when a company makes profit from their business operations, for the most part, there's two paths the profits can take. Number one, it goes towards the retained earnings, or number two, it gets paid out as dividends. Retained earnings are the profit the company uses to reinvest back into the business to grow, to do R&D, to scale, to buy back shares, to hire more staff, to buy a new sign for the building, to expand, to become better. It's kind of like how you wanted to invest into yourself by learning a new language, and you have been using Duolingo for almost a year, and you still can't say a single sentence in Mandarin. Props, man. I'm so proud of you. And then, as I just alluded to, of course, the profits can also be given out as a cash reward to the shareholders in the form of dividends. So what you see on your screen right now is Johnson & Johnson's credo, which is their company mission statement. They have an entire paragraph dedicated to bringing value to the shareholders, and J&J is not alone. Most Fortune 100 companies in the US operate with the shareholders in mind and prioritized. I've sat in meetings with vice presidents and senior directors, and let me tell you, the shareholder is not an afterthought. This is not lip service. The name of the game for a good company in the US is to grow the stock price. All right, small nipples, could you please expand on what you mean by share buybacks? I sure can, you double chin. Share buybacks is when a company repurchases its own shares from the stock market, which in effect reduces the number of outstanding shares. This can increase the value of the remaining shares and is often seen as a tax-efficient way of returning value to the shareholders because dividends are taxed, unless of course it's qualified. So let's go ahead and say that you're invested into the cheese company and there's 100 shares outstanding. If the cheese co buys back 10 shares, now there's only going to be 90 shares left on the stock market, which means quality over quantity, and the stock price goes up. Does that make sense? I don't know. If you don't understand that, you just got to watch this part again. So why would a company do this? Share buybacks. Oh no, look right here on the top right of your screen. I left these circles by accident. Whoops, I meant to put them like right here and right there. Okay, whatever. A company does this when they think their stock price is undervalued and they have more cash than they know what to do with. Instead of just sitting on piles of cash like Japanese companies do, American companies are obligated to create value and return money back to its shareholders and board of directors. That's who they work for. They don't work for the CEO. They don't work for the CFO. They work for the shareholders and the board of directors, the true owners of the company. So sometimes they'll grow their dividend and they do share buybacks if their business can't grow at a rate that satisfies all the smelly shareholders. So buyback is a dividend ETF that has a whole portfolio full of companies that are buying back shares and giving a dividend payment. The full name is the iShares Core Dividend ETF, but we're just calling it buyback ETF, and it's currently trading for about $48 a share. It's up by 16% year to date, and its dividend yield ranges from 1.6 to 3.2%. It's currently spitting out a 2.7% dividend yield. The top two holdings include Cisco and IBM, which are two old school tech companies that are fighting to stay relevant. Kind of like your receding hairline. Just give them a break. Throw in the towel, shave your head, and embrace the bowling ball shiny head look. Your comb over is not fooling anyone. Just go bald. You're meant to be bald. Just do it. Just do it. So what's the criteria for a company to join the buyback ETF? First, the company needs to be a part of the Morningstar US Dividend and Buyback Index, which is what this ETF follows. So within that index, companies are given a shareholder yield score based on their dividend yield and share buyback yield. And fun fact, dividends are given a higher weighting to boost income and to reduce turnover, as dividends tend to be more stable than share buybacks, meaning dividends can pretty much be expected every single year for a high quality company, right? On the other hand, share buybacks usually happen every so often. It's not every single year. So out of all the companies that have a shareholder yield score, buyback ETF selects and prioritizes companies based on how much they return to shareholders, starting with those that give back the most. It's pretty straightforward. Try not to complicate things. Like that one time you got really drunk one night and you called an Uber to take you from your couch to your bed. You blame the alcohol, but if we're going to be honest, it's because you are fat. And when we look at the breakdown of sectors within the buyback ETF, it's pretty diversified for the most part, unlike your HR department. And as you can see on your screen right now, buyback tends to skew heavy in tech and finance, which tech is known for their growth rate and finance is known for their really high and stable dividend yields. It makes a lot of sense. And depending on the day and hour that you look at the buyback ETF, they have about 438 to 440 holdings in their portfolio, meaning there's over 400 companies represented in this ETF. And what you see on your screen right now are the top 10 holdings. The biggest one is obviously Cisco at 4.99%. And I would say the only questionable one out of the top 10 is Verizon. And I say that because most dividend investors that invested into Verizon are most likely in the red with that one. It sucks. Verizon stinks. Now I hear you. Enough of the profile, description, and overview of the buyback ETF. Start with the movie already, will ya? Okay, first of all, sir, this is a McDonald's. Please calm your titties. Now, with that said, let's go ahead and talk about the past performance. And as we look at the numbers, we're going to compare the buyback ETF to SCHD as a benchmark because let's be real, SCHD is the GOAT, the greatest of all time, the one with the biggest wiener of them all. With 10 grand invested into both buyback ETF and SCHD back in January of 2018 and reinvesting all dividends, look at the outcome. That $10,000 would have turned into $21,000 with buyback ETF, and with SCHD, it would have turned into 20.5 grand. And when you break that down year over year, the CAGR for buyback ETF is 12% a year, meaning your money would have grown at a rate of 12% every single year. On the other hand, SCHD, 11.4%. It pales in comparison. Shut up. This is pretty close. It's not that bad. But when we look at the volatility, I mean, SCHD is just more efficient than the buyback ETF because during buyback ETF's worst year, which was in 2022, this blue bar graph right here, it went down by 10%. On the other hand, SCHD's worst year was 2018, and they dropped by 5%. Even if you're not a math person, a 5% drop sounds a lot more fun than 10%. And when we look at the adjusted ETF price for the past 5 years, SCHD has been up by 91%, which sounds amazing and beautiful. On the other hand, buyback ETF has grown by 97% in the same time period. So in the long run and in the short term, buyback has beaten SCHD in terms of total return. So far, we know that buyback has performed better in terms of total return. But what about the dividends? Well, let's go ahead and talk about that. But before we do, would you mind tapping like on this video? Because if you choose not to, then check this out. This is your punishment for not clicking like. All I can say is I am bullish on the US stock market and in American companies. And I know when I say that, you might be offended at the fact that I'm so optimistic. But time and time again, like I say in my videos, the US stock market finds a way to keep going up. And the sad and crazy part is, there are some negative Nancys that are out here that are still sitting on the sidelines with their cash. They're waiting for a crash, they're waiting for a correction, they're just sitting there with with their cash, and they are the true losers. The same type of men to wear white tighty whities with a brown stain right down the middle. As a guy that is constantly monitoring stocks on my watch list, almost every single high quality company is on the up and up. It's hard to say if there's any undervalued dividend compounders out here anymore. But check out this article from the Wall Street Journal. Americans are really bullish on stocks. And I know all of you can read, some more than others, but Americans have rarely been this giddy about the stock market. They are piling into stocks as major indexes reach new highs. The S&P is already up 18% year to date. The surging stock market has minted millionaires. As of the second quarter, the number of 401k retirement accounts at Fidelity worth at least $1 million has reached 500,000 people. That's up from 31% from a year prior and a record high. And investors are still feeling good about the market at a time when many people are turned away by the higher prices for eggs and all the other grocery items. The S&P 500 has hit more than 36 fresh records this year alone. And check out this interactive graph right here. Back in the 1982, household allocations to U.S. stocks, 9.4% of their financial assets were put into the stock market. As we fast forward throughout the years, now we're sitting at 42%, meaning 42% of their total financial assets are invested into the stock market. And that's more likely through their 401k or Roth IRA. They're not dividend investors like you and me. I was just going through my 401k and holy macaroni, wrote Steve on social media platform Twitter. The 51-year-old said he has been steadily investing for years and poured more cash into the market over the past one after landing a raise at work. That's exactly what you're supposed to do. When you get a raise at work, don't allow your spending habits to bump up a pay grade. Instead, live below your means and invest the extra money into the stock market. That's how it's done. Put that extra money towards yourself and have that money work for you in the stock market. Investors have been reassured in recent weeks by data showing the economy is still humming along, and the Federal Reserve Chair Jerome Powell signals that an interest rate cut is a few weeks away. I'm telling you right now, when that happens, our dividend favorites like Realty Income Corporation and SCHD, they're going to skyrocket. I could be wrong, but that's what I'm predicting. And now back to the video. All right, we were talking about the dividend, right? So for SCHD, the dividend went from $1.05 back in 2014, and now it's $2.66 as of last year. And for the past 10 years, SCHD has been growing their dividend payment on average by 11% each year. And the current dividend yield is somewhere around 3.3%. When we look at buyback ETF, you don't see any data for 2014, 2015, and 2016. And that's because the buyback ETF came to life on November 2017. So it doesn't have as much history as SCHD. But in the beginning, look at this. 2017, they paid 10 cents as their dividend. And just last year, now they pay $1.31 per share in dividends. And it's been growing that dividend on average by 16% year over year, which is not a joke. That is just ridiculous. And remember, the current dividend yield is 2.7%. So after looking at everything, what are my thoughts and opinions? Well, I'm going to be honest. The buyback ETF makes SCHD look like a small, hairy nipple. And I say that because the buyback ETF is a fantastic dividend ETF that we don't know about, but now we do. I like it a lot. And dare I say, I would invite it over for dinner and let it sleep in my dog's bed. And I would even let him take a nice steaming dump on my nice toilet seat. That's how much I like the buyback ETF. I think he's fantastic. Now, this is where I'm going to be a hypocrite, because even though the buyback ETF has performed better, I still prefer SCHD because of the higher dividend yield and its reliability in terms of volatility. But the real question here is, why choose one over the other? This isn't Russia or China. I have a choice. I have the freedom. So with that said, I would go with both in my portfolio. So what do you think? Which ETF do you prefer after seeing everything? If you're trying to tell me that you prefer to poop after you shower, then I hope you know you're doing things in the wrong order, pal. And until next time, stay safe, everyone. I'll talk to you really soon. Peace.